The S&P 500 just hit the 100th percentile, and the S&P at this level has historically marked a regime inflection. Something is breaking beneath the surface, and the data confirms it. Right now, the S&P 500 is at 7,173.9, the 100th percentile for the past year. Historically, the S&P at this level has historically marked a regime inflection, says the data needs to confirm. The commodity analyst says we are in a commodity supercycle driven by underinvestment and deglobalization. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The scoreboard just changed. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. The commodity analyst is right and the data keeps proving it. Oil at $99.6, 128-day streak. The dollar analyst just moved from early to right. The dollar analyst called it dollar milkshake higher. Gold at $4,625 confirms it. The volatility expert just moved from wrong to right. The volatility expert is right and the data keeps proving it. VIX at 18.7. Too early to call McElroy right or wrong. The thesis is building but not confirmed. 127-day streak, Hartman might be right, but the data has not confirmed the thesis yet. 121-day streak, bad stretch for Gammon, for now. Yield curve at 0.57% says the opposite of credit will blow out. 4 days running, Snyder's call is not working, for now. Yield curve moving against the bearish thesis, up 7.5%. 4 days running, score today, 3 right, 2 early, 2 wrong. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. Today's big question, are commodities in a supercycle, or is this the top? On one side says, the data needs to confirm. That is the setup. Everyone hears it on the podcasts. It sounds convincing. On the other side, the commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. Two smart people, opposite conclusions. So who is right? Here is what makes this interesting. Oil is rising while gold is falling. Those two signals should not be going in opposite directions. When they diverge like this, one of them is lying, and the resolution is usually fast. Oil at $99.6, 97th percentile, up 3.4% today. Gold at $4,625, 76th percentile, down 1.1% today. Copper at $5.99, 94th percentile, down 0.5% today. Bottom line, the data is split. Neither side has a clear edge, which means the resolution is coming soon. If oil drops below $80, the supercycle call is in trouble. Right now, it is at $99.6. If copper breaks to new highs while oil falls, it is demand rotation, not a supercycle. Oil at $99.6 is in the 97th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,625. We'll track it daily on the scoreboard. Phase 1 is the good times, but good times do not last forever. Here's how close we are to the edge. We are 70 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we're watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points, currently at 80 basis points. Pace is flat or improving. No urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has yield curve, initial jobless claims flashing red. Gammon says, the Fed is breaking things and credit spreads will blow out. The data disagrees with that thesis right now. Phase 1 holds with 70 basis points of buffer. Conditions favor risk but do not get complacent. Wall Street trades the index. We trade the ground. Here's what the ZIP level data is screaming about today. Quitman, MS, lenders are saying no, at scale. In Quitman, MS, the HMDA denial rate is 68% across 50 applications. Top reason, credit history. Credit doors closing is the slowest, surest signal of a turn. East Carroll, LA, lenders are saying no, at scale. In East Carroll, LA, the HMDA denial rate is 67.1% across 70 applications. Top reason, credit history. Credit doors closing is the slowest, surest signal of the turn. And why? Days on market is spiking in Kingston. Days on market in Kingston moved plus 100% in 30 days, now 127 days. Buyer leverage score, 75 on 100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, are commodities in a supercycle, or is this the top? Let me show you what happened the last time we were here. Oil at $99.6 is in the 97th percentile. That means it is higher than 97 out of 100 days in the past year. In 2022, oil spiked above 120, then demand destruction pulled it back 40% in months. In 2020, oil went negative for the first time in history as demand collapsed. In 2018, oil dropped 40% in Q4 as growth fears overtook supply concerns. Different environments, different catalysts. But every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, copper at $5.99 is in the 94th percentile. The last time both oil and copper were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. History does not pick a winner here, but it does say the resolution is coming soon. Be positioned before it arrives. Here's what the data says to do right now. Stay alert on VIX. It is dropping 3.1% today. Fast moves demand attention. Avoid Phoenix at 40% payment burden. That is stretched territory. Phase 1 holds. No alarms. But the runway at 70 basis points is shorter than last month. Every signal is live at analyze.builderslens.com. 7 speakers, 65 signals, 1 question every morning. Who is right? Subscribe, and I will see you tomorrow morning.